This tells me that the sentiment, if you like, in bullion markets is still immensely bearish. I mean, I'm not saying bearish in the sense that people are shorting it. No, of course they're not. But they're just completely disregarding it. They're disregarding the messages that are coming out of the bullion market. They may not understand the messages. I can understand that. But they're not even trying to think, perhaps this is something we better find out about. They're not even at that stage. 2024 was interesting. 2025 is going to get even more interesting, I think. I would see these currencies, the fiat currencies, going down in 2025 at least as much as they've gone down in terms of their purchasing power, measured against real money, which is gold. And there are other problems.
Gold has long been revered as a safe haven during economic uncertainty, maintaining its purchasing power over centuries. However, many investors don't realize that traditional market forces like supply and demand do not solely determine the price of gold. Instead, there are hidden forces at play that manipulate gold prices, often keeping them artificially low. Alasdair Macleod has pointed out how major financial institutions, central banks, and the derivative markets work together to control the price of gold for strategic economic reasons. Through mechanisms like futures contracts and financial derivatives, these entities create the illusion of a larger gold supply than exists, suppressing the true value of the metal. One of the primary mechanisms behind this price manipulation is the derivatives market, particularly the trading of futures contracts on exchanges such as the COMEX, Commodity Exchange, Incorporated. These futures contracts are often traded in large volumes by financial institutions, but they are mostly paper gold, meaning they are not backed by actual physical gold. This creates an illusion of a larger gold supply than in reality, suppressing prices even when physical gold is in high demand. As a result, the true market value of gold is distorted, with its price remaining artificially low despite rising demand. Similarly, the silver market, though valuable, is much smaller and more liquid, making it particularly vulnerable to price manipulation by large institutional investors. A famous example of such manipulation occurred in the 1980s, when the Hunt brothers attempted to corner the silver market, amassing vast quantities of physical silver and triggering a market crash. The rise of short-selling leveraged positions and exchange-traded funds, ETFs, not backed by physical metals, has further contributed to artificial price fluctuations, adding complexity to a manipulated market. As we bring you clips from the discussion, please take a little time to like this video, subscribe to the channel, and turn on post notifications for more videos like this.
The implications of what you're saying is that the market is getting less liquid. I mean, significantly so. And there is another aspect I've noticed on COMEX, and that is that the mining the mines, they're not hedging it. They're not hedging forward production as much as they have done in the past. And this, of course, throws the onus on the swaps, who are the other side of it. And, unless they've actually got physical sort of tucked away somewhere, they can't actually cut their short positions down at all. I mean, it's just stubbornly refusing to go lower. So it's a tricky thing. And I think what we're seeing, to develop what you were saying about, which sort of implies that liquidity is drying up in the futures markets. What we're beginning to see, I think, is a bear squeeze on the system. And that has got interesting implications. The root of all this, basically, is that this gold is just still disappearing from here and going into firm Asian hands. I think that, the whole of the BRICS thing and all the rest of it, that's going to die down because I think I'm right in saying that Brazil is the new chairman. But so what will happen is that you won't get much on the headlines. I mean, I understand that Lula has got he's having surgery on his brain because he had a hemorrhage from a fall. I can't see the Brazilians doing an awful lot, but I'm sure that the Russians and the Chinese in the background will continue the good work, I put that in inverted commas, which they did particularly under the Russian presidency, which is, has got another 2 weeks to run. That side of it, I think, is going to quieten down. But this doesn't mean to say that selling of the dollar in return for gold is going to die down as well. I mean, I think that can easily accelerate. I mean, the thing that's fascinating is if you look at the psychology in the market, there is virtually no bullishness in the West. I mean, apart from obviously the odd punter in the futures market who thinks, he sees a momentum and he buys the momentum. He's clueless really on that. Or he's just doing a pairs trade. I mean, he's looking at dollar versus gold and gold versus dollar. He's not interested in taking delivery. He's just got a leverage play against one or the other, and he doesn't actually care which. That is the way a trader works, which is absolutely fine. But other than that, I don't think there is anyone really, apart from a few oddballs like you and me, who actually understand what's happening to the currencies and therefore what is going to be reflected in the gold price and why you should hold gold. Buy gold, and stack it. I mean, we know this because the gold is going out into Asia. It's going into the central banks. It's going into the government wealth funds in Asia. I mean, I can see that that's quite a lot of where the Chinese stuff is going. You've got the Chinese people too, who can't actually rush out and buy dollars or whatever to hedge their own currency. Yeah. And, interest rates are tending to drift lower in China as a matter of policy. So, everywhere there's gold accounts, and you've got gold accounts in Russia as well. You can open a gold account at the bank. But the thing is that these guys actually cover their positions. They don't run fractional reserve, as we would call it. They don't run these leverage positions or uncovered obligations. So they cover them. And so there is enormous demand amongst people who are frightened of the West and what they're doing to currencies. But that does not include our populations. They've yet to buy it. This tells me that the sentiment, if you like, in bullion markets is still immensely bearish. Because, I'm not saying bearish in the sense that people are shorting it. No, of course they're not. But they're just completely disregarding it. They're disregarding the messages that are coming out of the bullion market. They may not understand the messages. I can understand that. But they're not even trying to think, perhaps this is something we better find out about. They're not even at that stage. And the average ownership of gold or gold substitutes, whether it's mines or ETFs or whatever, is still a tiny part of everyone's portfolio. And of course, this is another thing. Once you get the switch out of the Nvidias of this world, which will happen because that's where the bubble is, then where does it go? Well, a lot of it gets destroyed, let's face it, because the markdowns are going to be sudden and severe. But what is left over is going to go into mines and ETFs and to a lesser extent, physical gold. So, this I think it feels to me, speaking as an old broken stockbroker, it feels to me like this is very, very early in the game. And this game, I don't know how long it's going to run, but I suspect an awful lot of people are just going to miss it entirely. And they will realize once they discover that actually what's happening is their currencies are going down, not prices going up. As far as the Chinese are concerned, if they're going to punt, they'd punt on Globex. I suppose some of the smaller punters may go for some of the mini contracts, and they are wild punters. They really are. That there is no doubt. I think there's the bigger play is something which we should be very much aware of, and that is that Chinese citizens save something like, households save something like 35% of their earnings. Now, 35% of their earnings is roughly $2 trillion. Now, that is going into bank accounts, property. Oh, no, not property anymore. The Shanghai Stock Exchange, well, a little bit maybe, but, that's not so much. But then there's gold. And so, we can see that this demand is continuing and continuing and continuing, particularly since Chinese nationals do not have access to foreign currencies to hedge out of their own currency. So, even if they don't understand the gold story, okay, they've got a predilection for gold, but even if they don't really understand the story, those who want to hedge out of their own currency are forced into gold or, to an extent, I suppose, silver as well, but particularly gold. So I think this is the beginning of the story. And, sort of concerning your question about the outlook really for next year, I think that these currencies, our currencies, have got a very rough time, which will be reflected in a far higher gold price by the end of the year. And that is without geopolitical events. I mean, that's another subject which, perhaps we can sort of touch on, because President Trump reckoned he could get peace in the Ukraine in one day. I mean, dream on. There is absolutely no way. I mean, he's appointed some pretty neocon types, if you like, on his, the sort of homeland security, the defense, and the intelligence services. I think that, the Russian demands are going to be very, very simple. The bare minimum will be they keep the Eastern Oblasts and Crimea, and they have cast iron guarantees that the rest of Ukraine will not join NATO and remain completely neutral. Now, I don't know how that later guarantee can be given. I don't know how the establishment in America, the neocons and all the rest of it, would accept that. I think they would probably, this is not going to be resolved in a day. It's going to be resolved on the battlefield, I'm sorry to say.
Yeah.
And here's an interesting thing. We've sort of took out sanctions, both financial and, goods and services against Russia. I'd wrote an article on the Russian economy the other day. It was prompted really by, sort of journalists in this country and elsewhere, saying that the economy is doomed and all the rest of it. I'm talking about the Russian economy, not our own. The Russians are doomed and all the rest of it. And I looked at this, this is actually completely wrong. And here's some key figures. On a purchasing power parity basis, Russia is now the fourth largest economy in the world.
Alasdair Macleod's forecasts regarding the decline in the global credibility of the dollar have been largely validated in 2024, as gold continues to solidify its role as the ultimate benchmark for real legal money. Central banks worldwide, especially in nations like China, have been actively increasing their gold reserves, further cementing its status as a safe haven asset amid rising economic volatility. Macleod emphasizes that the rising gold prices are not a reflection of an inherent increase in the metal's value, but rather a signal of the weakening purchasing power of fiat currencies. He predicts that this shift will become increasingly apparent to the public, potentially sparking a wider collapse of fiat currency systems as people seek more reliable stores of value. Macleod advises investors to focus on accumulating physical gold and silver, rather than relying on exchange-traded funds, ETFs, which offer no real ownership and fail to protect during systemic crises. He also draws attention to the current gold-to-silver ratio of 80-1, considering it unsustainable, with silver likely to outpace gold in value appreciation as the market adjusts. With G7 nations' debt levels and risky economic policies escalating, Macleod foresees further economic instability, accelerating currency devaluation, and increasing global financial risks in the coming years.
Probably surprised a lot of people that despite the price rise, the Chinese are continuing to buy. So are other central banks. So what's all this about? Well, the answer is quite simple. And that is, it's not gold going up, it's paper currencies going down. And this is very, very important. It's very important to get this message early, because when the general public finally realizes that it's not the price of eggs or the price of coffee or whatever going up, but actually the purchasing power of their currency going down, then the currency is doomed. And when the general public wakes up to it, I can tell you the dollar, sterling, euro, yen will all be a lot lower. Now, I put it that way rather than saying gold is going to be a lot higher, because if you think as an investor, you look at gold and you think gold's gone up. As we talk, I don't know what it'll be when this is released, but as we talk, it's had a good day. I see it's up $18. It's currently trading at 2,712. Challenging the levels we saw, 4 weeks ago. If it breaks that, then it's going to go and hit new highs and so on. But do we really want to pay this much for gold? Perhaps we should hang on and wait for a decent shakeout. It's gone too far. But the point they miss is it's not gold going up. It's the currencies going down. Now, obviously, nothing goes down in a straight line or in an even tempo. But I think if you understand that, then you understand that really what your strategy should be is not trading it, but actually accumulating it and accumulating the physical, not paper. Now, this is a very, very important point. And of course, the whole of the investment industry has a difficulty here because gold is not a regulated investment. So how do you get it past your compliance officer? Well, the answer is you go out and buy ETFs. But your problem with the ETF is you don't own the gold. And worse than that, not only do you not own the gold, you don't actually own the shares in the ETFs unless you have specifically decided to take delivery of certificates. Now, this is a very important point because the owner of, or if you like, the owner of the certificates, in effect, is, the clearinghouse, the intermediary, the big boys in the middle, basically, who guarantee settlement, Euroclear, whatever. And why have they got it? Well, I mean, the answer is quite simple. You've got a huge, great derivative mountain, which is absolutely enormous. And the fear is that at some stage we get a crisis and that could be jeopardized. So what they want is they want your stock to have as collateral to deliver in order to ensure that that whole mountain of deliveries of derivatives doesn't collapse. So, ETFs don't get you out of it. The answer basically, I'm afraid, is you've got to accumulate coin and bars, both gold and silver. Silver I regard as gold on steroids because, I mean, the gold-silver ratio is just crazy. I mean, at 85 or something as we speak. This is nonsensical. I mean, I don't see it going back down to the sort of 15, 16, if you like, when when silver was treated or valued as money. I don't think we're going to get there. But these levels on the ratio are just absolutely crazy. And as gold goes up, silver will go up twice as fast to bring that ratio down to something which is, if you like, more sensible. So I think, 2024 was interesting. 2025 is going to get even more interesting, I think. I would see these currencies, the fiat currencies, going down in 2025, at least as much as they've gone down in terms of their purchasing power, measured against real money, which is gold. And there are other problems in the background. And I think one thing that could really drive this very, very hard is the debt mountains that governments have. I think the psychology of it in the West, we are so far behind. We really are. And if you look at the mining sector too, there are mines which are so incredibly cheap. If you have half an understanding of the potential for the relationship between fiat currencies and gold, and of course, the institutions will switch quite rapidly out of the sort of tech stocks and all the rest of it when that bubble goes, and they'll be walking into trying to find mines. And how many analysts do they have now? I mean, there are very few actually good analysts. I mean, brokers haven't invested in analyzing and covering the mining sector. It's a dirty business and all the rest of it. And anyway, it's been dead for Christ knows how long. Why chuck good money after bad has been the approach. I can see that there's going to be some very, very big shifts, if you like, in the entire investment scene in 2025. It's very interesting times, I think, very interesting. I mean, interesting in the sense that, we'll be watching, it's rather like a public execution. You'll be watching people dangling on an end of a rope, sort of speculating how long they're going to be twitching, sort of thinking, hold on, this could happen to me. There's a sort of that sort of feeling, watching these developments. For those of us who have, if you like, an understanding of the relationship between money and credit, this is actually a very, very serious junction.
The hidden forces behind gold price manipulation are a stark reminder that not everything is as it appears within the financial markets. While mainstream media may downplay or ignore these issues, seasoned investors understand the importance of looking beneath the surface to grasp the real dynamics. Central banks and governments, with their vested interests, actively work to suppress gold prices. Rising gold prices are often interpreted as a signal of diminished confidence in fiat currencies. If gold were allowed to rise freely, it would reveal the true extent of currency devaluation and the inherent risks linked to excessive money printing by central banks. This kind of transparency could lead to a loss of trust in the fiat currencies that underpin modern economies, thus destabilizing financial systems worldwide. For governments and financial institutions, keeping gold prices subdued helps maintain the illusion of stability. However, savvy investors who stay informed and invest in physical gold can safeguard their wealth and potentially capitalize on the opportunities that arise from these manipulative tactics. As more people become aware of these practices, the demand for physical gold will likely increase, driving its price up. Please share your thoughts on Alasdair's analysis in the comments below. Also, ensure you like this video, subscribe to the channel, and turn on post notifications for more videos like this. Thanks for watching.